Dave Lee and his friend Emmet Peppers recently gave an update on Lemonade stock on Dave Lee's channel. At least shared some of their most up-to-date opinions on the stock. And in this video, I wanted to give my reaction and my thoughts that are spurred on by the thoughts and dialogue that they had. So feel free to check that out. And also, if you are considering getting Lemonade insurance, I now have an affiliate link. So if you want to support the channel, make sure to use my link whenever you do sign up for Lemonade insurance. And if you get value out of this video, make sure you hit that subscribe button down below and the thumbs up to really help that YouTube algorithm. Thank you so much for watching and enjoy.
Lemonade. Earlier, you said that you guys have strong conviction.
Yeah.
I'm kind of wavering a lot. I actually reduced my position recently by like 25%. I might do another 25%. But my big kind of thing I'm having a hard time grasping with Lemonade is, like, on one side, I understand the long-term potential. It's in a huge market. Yeah. They've got some decent values, some competent management. I love the management, like they're smart guys, they know what they're doing. They seem to really empathize with the customer and try to deliver the best product. But on the flip side, my concern is the marketing spend and also the churn rate. And like, they don't really publicize like how many people are leaving. But when I work out the numbers, it is a lot that they're spending. I think that's kind of the core of one of the big things of the Lemonade business model is it's so dependent on marketing, like cost of acquisition for each customer, and you have to factor in the people leaving as well. And when I take a step back, personally, I want to be heavily invested in a company that doesn't really need marketing spend to grow, but they use marketing spend to accelerate their growth. That's fine. But with even without much marketing, they have such a strong product that they're able to grow on the product itself. But with Lemonade, I feel like you cut their marketing to zero, then it's gone.
So I see what Dave is saying here in these comments, that Lemonade, he's basically saying, it's not really sexy enough of a product. It's not, it doesn't push kind of its own sales. It really requires a lot of marketing spend to make the sales happen. And if you contrast a company like Lemonade to a company like Tesla, I totally see what he's saying and I would agree with that. I mean, Tesla, you think about it, it's really different because it offered such a major shift to such an important product to your everyday life, your vehicle, your transportation, your wheels. It's such a key part of your everyday life, and the switch to electric is such a profound switch, and the sort of the computer on wheels that Tesla has built is such a profound switch that people day to day really absolutely love the product, and that drives a ton of word of mouth sales and message. Basically, in my mind, every Tesla the Tesla sells is going to be selling more Teslas, for the foreseeable future, because the market's so huge. So every single Tesla you sell, shows up on a block on your street. Your neighbors ask you about your Tesla, and more people then want to buy a Tesla. and that's sort of true all over the world, will be true, because it's so profoundly different. But on the other hand, how loved really is Lemonade? Does it drive word of mouth sales to the same degree? Obviously not the same degree as Tesla. And I think just because insurance is, even if you differentiate the insurance product, even if you make it really a much better user experience, you're still probably going to require some marketing spend, or it's going to be a key part of your platform, of your strategy. Simply because people they're not using it on a day-to-day basis. They're sort of setting their policies up and then forgetting about their policies and then changing it when they have to, or making a claim when they have to once in a rare while. But otherwise, they're not on a daily basis. They're not bringing it up. They're not using it. It's not like a Tesla. You literally show your friends and family and neighbors, give them a ride in the Tesla to show them how awesome it is. There would be some, I think, word of mouth with Lemonade. So I totally agree with Dave. Not the same kind of word of mouth sales. Marketing is a key part of their strategy and something I am planning to look into more. I am looking into more. I want to do some more videos on their marketing sort of spend and efficiency of that. But on the other hand, Lemonade does have a net promoter score of something, at least what they have published, is something in the order, it's like around 70, which is similar to other very, very loved and beloved brands. So to me, there's still kind of a scale. You're competing against, you're talking about an insurance company, you're competing against all the other insurance companies, which in general have much lower net promoter scores. And you have a company that people really do seem to love, 5-star reviews across the board. So it's some kind of differentiation there. And we'll talk about that later in this video, some more reaction to their comments, how Lemonade is differentiating themselves. But I do think, I agree with what he's saying. Yeah, it's not going to be as good as Tesla, but I think it's better. Lemonade is better set off and better differentiated than legacy incumbents than Dave's really giving them credit for.
Insurance, though, insurance is just not sexy. Like, no one really is like talking about insurance really, with their friends or family. Like, I got this great insurance provider. No one's like a Tesla. I got the cool car. You don't need to. It's like you're driving it around. It's a physical thing. Insurance, I feel like there's no other way. They have to do some kind of marketing spend. But I agree, it's a concern.
So that's funny. It's exactly what I kind of said is what Emmett then just said, and actually hadn't listened to this. This is kind of raw feedback here, reaction to this video. I hadn't listened to this recently, so it's funny that Emmett kind of reiterated my points there.
Now, the churning, I've heard them lose customers perhaps because they didn't have auto insurance, for example. So maybe they had customers, they were using them for renters or homeowners like new college grads, and they're like, who do we use for auto insurance? We want to use it. And they're like, oh, we don't have auto, go to Allstate. And then Allstate or USAA, and USAA says, hey, we'll give you an all-in package for your renters and your auto insurance, and they end up leaving Lemonade. So
customer churn, I'm not exactly sure what data Dave is talking about here. I'd be really interested to see if he publishes or shows more information or reaches out to me if he wants to talk about some of the data. I'd love to see that. In my interview with Daniel Schreiber, the CEO, he spoke about them tracking churn or kind of customer churn by measuring cohorts of people over time and sort of what they're adding or subtracting to their insurance policies. So you can see some of that. He touches on that in that video. You can look at that. But I agree with what Emmett said that they offer more products in more places, so all their products are offered in every jurisdiction or every area, and then there's I think there would be a bundling effect, especially around key products like auto insurance. If you pair that, say you have your home insurance, but now you could not get auto insurance. Some people maybe signed up for it, tried it out, and then decided to switch to another insurance provider just so they could bundle the two together and maybe get some savings with that bundling. But I think Lemonade's going to be able to offer some of those savings as they bundle more of those products, which is going to just keep people, locked in without switching or maybe churning out as well. I also think something to note, they didn't touch on this, but I think interesting to note is with a company like Lemonade that has a more efficient system and more efficient administration of insurance in general, that they can offer some cheaper niche products that other insurers would not offer, such as things like renter's insurance. And they could also offer things like, you want e-bike insurance, something like you have a $2,000 e-bike, you want some insurance on that. You could have a little product that they could offer and administer very effectively and draw in and be good customer channels for those sort of people. So those kind of products by their nature, especially on a customer count basis, are going to have more churn than, say, more established products if you're comparing that. So, if you, because the nature of those are, they're going to be they're going to be bought by people that have more transition in their life, and they're more temporary. Like if you have an e-bike for a few years, and then you stop riding your e-bike and you get a car, and maybe you're going to cut off that package. Or if you're a renter and maybe you're renting an apartment and you're going to school, you're a young person, which then you might be paying for renter's insurance and then decide, actually I'm moving back home or I'm moving somewhere else, and and so I'm actually going to cut off that renter's insurance, or I'm moving in with a friend or something, and I don't need renter's insurance now. Some of those people, they're just going to, those are sort of policies or packages that are more likely going to have customer churn just by default, because the people buying them are going to have more transition in their life. Versus established insurance companies and the products they might only selectively offer, the things like, your life insurance, auto insurance, house insurance. And if somebody's 30 years of age and gets older than that, and they're married and they have kids and a stable job, they're very likely they're not planning to move very much and move around much or at all. And their insurance packages that they're signing up for, they're kind of going to set and forget about.
One potential argument is maybe now that they have auto insurance, which is like the biggest piece of the pie, they won't have hardly, or they'll have a lot less potential people leaving. But I haven't, where have you looked at those numbers, or have you backed out of those numbers? You said you kind of figured, somehow looked at the numbers. What are your numbers? How did you figure that out?
Yeah, I mean, it's a combination. Like when I interviewed the CFO, he was saying like how they can pretty much like get back for when they spend money on to acquire a customer. It takes them like, I think around 2 years or a little more to get back that money. But when I worked out the numbers more recently, it just seems like, the marketing spend is, it didn't, I realized I didn't factor in like the number of customers that were leaving, because the marketing spend was a lot higher than that made sense. But when I added in a certain number of people who are leaving, then the numbers, I'm like, oh, that's why the marketing spend is so much. But yeah, it's kind of this nuanced thing. And I mean, for anyone invested in it, I would definitely, say like do a deep dive just on the numbers, because it's subjective in a lot of ways, I think.
Since I did my interview with the CEO of Lemonade, I have been thinking a lot about when might they actually become profitable, and connected to that, how efficient is their marketing spend, because that is a really big question of whether they will become profitable, how efficient their sales and marketing expenditure is. So I do plan to do some more videos related into those topics as I dig into them, so make sure to subscribe if that interests you. But I'm not sure the data Dave is talking about with the customer churn, because really the only data I kind of see we have is sort of the net customer change quarter to quarter. And really, that really is all that matters, is if the net customers goes from here to here, and even if the customer actually went from here and then dropped down because a certain amount churned, you're still only seeing that kind of net change difference with the data that is released. So I'm not sure why he'd be thinking about how much is churned. Of course, how much is actually gained from overall, I think is what is sort of the critical metric to look at. And what I've looked at so far, just I still want to dig into this further, but their marketing spend, if you look at how much they're spending on a quarterly basis and how much net customers they're gaining, it's something around, they've been kind of averaging $200 to $300 spend per customer acquired, your CAC, your customer acquisition cost. And from a little bit of the data I've seen, some studies that have been done, legacy insurance companies are significantly higher. They can be, I think some of the better companies that are more streamlined, like say like a Geico, could be around $400 to $500 per customer acquired, but other legacy insurers I've seen sort of averages closer to $900. So I think, on a net customer gain basis, at $200 to $300 per customer, Lemonade is doing really great. I do plan to look into this in more detail, though, in future videos again. So make sure to subscribe if you want to be in touch and see those.
But
I'll look into that deeper. Yeah, I want to look into that a little deeper. Maybe I can figure out from you the what metrics specifically you were looking at later. We can chat about it. Email or something.
Get Matt on it too. Like, just there's a section in my interview with the CFO about marketing metrics and spend, and then compare that to the spend. I think the other thing our challenge with Lemonade is differentiation of product. So one of the problems with Solar City back in the day was the product wasn't like that different, and that's the thing. It didn't have that advantage over its competitors. And so when I look at Lemonade, like, sure, it has like, you know, easier user experience, quicker sign up, but the actual ownership of the insurance, which of course I guess claims might be easier, but I don't know, it's not revolutionary in the sense where it's so differentiated that people are like, oh my gosh, like this is the holy grail, you know?
Yeah.
What Dave is saying here, but I would disagree with him as well. I feel like he's kind of shifted to an attitude of, well, you know, insurance is insurance and there's nothing really different about it. So, you know, what does Lemonade really have to offer? I would disagree with that. Definitely disagree with that, because in my mind, the typical insurance process, you know, it has some major flaws and faults about it. You feel at odds with the insurance company. It's often unclear exactly what you're covered for and what you're not covered for. If you ask someone exactly what you're covered for, you know, on their home insurance, it's probably the average person is actually going to be hard to answer you. And even if they looked at their policy, they might have trouble even answering you. And the user experience, I mean, it's fine. It's okay. Nothing really terribly wrong with it, but you often have to like contact a broker to communicate or sort of have any kind of change. Not a big deal, not bad, but it's not the kind of, you know, it might take a few emails, but versus what Lemonade offers, the flip side is they really have much clearer policies. It's all organized inside of one app on your phone that you can just open up at any time. You want to check, you figure out what insurance you have or don't have or make changes. You can easily, simply do that. Even if you have a claim, you can submit a video, you know, a file explaining the claim and details of the claim in a few minutes, and you literally be paid back for the claim in minutes. Like, that's incredible versus the headache that a typical insurance claim might have or could have around it, or even just the longer, a little bit more longer drawn out process. So to me, saying, you know, insurance is just like insurance is kind of like saying, you know, that a Tesla is really not much different than a gas vehicle. Like, yeah, on one hand, you can kind of make that argument that yes, you can drive a gas vehicle. It gets you from point A to point B. You can fill up in gas stations. Very convenient. Everyone drives one. People know about them. There's mechanics for you. Yada, yada. It's all there. But so it's true in a sense, but I think it's also kind of missing some of the details of why customers love Tesla vehicles so much, if you're kind of making that comparison. So, and also in my interview with Daniel Schreiber, he spoke about, for Lemonade, how their digital system that they built, this sort of digital substrate, can really make things more efficient, which results in significantly and faster customer experience. Sort of kind of what we're talking about, because it's built on that base. So, it offers that experience for the customer, but it also offers more efficiency for Lemonade. So they need less people to administrate the same number of policies, which is, they've shown data to show that's true, which allows them to offer then more niche products like things like renter's insurance, or even some sort of weird thing like e-bike insurance have been thrown out there. And I'm sure there could be other little niche products they offer going forward into the future. Which isn't going to necessarily, those sort of products might not be huge money makers for them. They might just make a little bit of money overall, a little bit of profit. But the real advantage for those is they can be inexpensive avenues to attract and delight new customers. So new customers, kind of their just customer acquisition channels as people come into the company, into the Lemonade ecosystem. And then as they already have the renter's insurance, and they're going to buy their homeowner's insurance from them, or more likely to down the road. So that's sort of the big advantage. You can efficiently suck in, draw customers at that lower, kind of cheaper acquisition level. That's the efficiency advantages of their digital substrate, but then there are also underwriting advantages on the risk prediction and accuracy side. The jury's still out really on this to make whether it makes sense and it could work. If Lemonade can more accurately measure your risk and prediction based, your risk, whether you're a safer person or you're a more reckless person, and based on the sort of digital fingerprints you're leaving on the app and how you're getting to the app and how you're functioning there, on top of traditional data and traditional proxies and metrics they'd be looking at as well. But if you can kind of stack those things together and get a more accurate underwriting, is really powerful, because then if you're a safer person, they can undercut prices of competitors and really attract you with better pricing, better overall experience as well. They're winning on that front, but then better pricing as well. And if you're a more dangerous person, they think, yeah, this person is more reckless and actually is like, we think is like 5 times higher, more likely they could burn down their house. Still very unlikely their house will burn down, but maybe 5 times higher than the other, sort of baseline person. Then they can charge that person more for home insurance, and either that person will pay more, which means they're kind of covered for that risk, or that person will just leave and go to a competitor. They've kind of pushed away someone who might be more risky to a competitor. So you kind of have that filtering of people, which is huge effects for the customers that are safer because they get better policies, better pricing, and for Lemonade. So what Dave's kind of writing off as like, insurance. No, this is a big deal.
Insurance.
I mean, I think it's very hard for any insurance company to put that together, though. It's just a business that's hard to wow people in that way. But I know you're saying, like, it's not like a new technological device or new technology that's been introduced. But the way, I guess, from a big picture point of view, look at Lemonade is sort of like a binary outcome, similar to what we used to think of Tesla. And either it's going to succeed, and auto insurance is the biggest piece of the pie, in my opinion. And that acquisition of Metro Mile, I think, was very timely for them and helps potentially catalyze that, accelerate it. It's a binary outcome. Either you're going to succeed and become like, a 10x, or they're going to fail and dwindle to zero eventually, be acquired or go bankrupt for pennies, acquired for pennies on the dollar, go bankrupt. So I feel like you just have to kind of analyze it like you're saying, and kind of put your own probability weightings on those kind of two outcomes in a way. And they might take 5 years to play out, but sort of like that's how it was with Tesla in 2011 to 2018 almost, like that whole time it was like you had to view it as a binary outcome. It's either going to succeed wildly or it's going to go bankrupt, right? And
I 100% agree with Emmett here that Lemonade still is a binary outcome, which is why for me it's not an all-in investment or something I would really bet the farm on, because they definitely there's still a good chunk. There's still pretty probable that they could go bankrupt, they could fail, they could just be bought pennies on the dollar, acquired by somebody else, basically. Be going close to bankrupt. So for me, it's why I'm still cautious with the company. I'm accumulating shares during this time as I can, especially these low prices. And if I felt the probability was to shift, that bullish sort of outcome, they're going to become profitable, they're going to keep scaling, they're going to be successful, become more and more profitable, then I would shift more of my portfolio into Lemonade and be more aggressive in my buying. But for me, still such a binary outcome that I still wouldn't go super aggressive myself. And if I think that probability is going to shift one way or the other, especially like I'm going to bet higher on them, definitely be letting you guys know my thoughts and my reasoning behind those thoughts in going forward into the future and future videos. So make sure to subscribe if you want those future updates.
It's risky, and they have enough cash on hand to survive for a while if they're not making more money. So I think the next 3 quarters, I think they're going to complete their Metro Mile acquisition within like 6 months. They did a couple of the Daniel Shriver, the CEO, did a couple interviews in the last week or two. One with this guy, Paperbag Investor, and one with Motley Fool, which was really interesting.
Got a nice little shout out there. Appreciate it. That's kind of cool to see these guys. As we're seeing that interview and watching that.
And I think there's a lot of information on there too. But the one thing I found interesting, the stat he gave out was talking about, and this is obviously you're talking to the guy it's his own company. He's only going to talk he's not going to say anything bad. So it's good to look at the bear case and the stuff you're talking about for sure. But the market is currently valuing Lemonade at like a book to value ratio when you back out the reinsurance. That's like, I think it's probably like 6 to 1 now, or 5 or 6 to 1. Probably was 7 or 8 to 1 when the interview was done like a week ago. But now the growth stocks have been hit, including Lemonade. It's probably like 5 or 6 to 1. But all the other legacy insurance companies are valued at like between a 1 and 2 to 1 book to value rate. So Lemonade, if it got cut in half again in its price, it's like valued on the same metric as the legacy insurance providers at that point, based on basically just its it's renters, homeowners, and pet insurance, and tiny bit of life insurance, right? The auto insurance hasn't even really started yet, and they're growing all those other insurances. All the legacy providers are growing or staying stable. They're hardly growing at all. They're really just kind of stabilized, And so for something that's growing, you would think the ratio should be much higher than the standard like 1 or 2 to 1 ratio. So
this is a good point that came up in the Motley Fool podcast where Daniel talked about a good way to try and evaluate a legacy insurer is by their book of business. So say you have $10 billion of in-force premium. A lot of legacy, kind of more typical established insurance companies might have like a $10 billion market cap, something in kind of that similar range of book of business to market cap. And I think it is kind of interesting. Yeah, I find after kind of every quarter of Lemonade's earnings, many people, you look at Twitter or forums or whatever, comment sections, people criticize and point out their high price to sales ratio. And this is partly, it's a high growth company, so you could just make that argument that they're too expensive or it's higher growth, but they are growing 80-90% year over year. So it's obviously high just because of that and the potential of the company, but it's also high partly because their reinsurance strategy, so much of their sales are ceded to reinsurance, and those would not be captured then in that price to sales ratio. So they're having sales or making sales, and they're ceding some of that to reinsurance, which is a really good strategy. Reinsurance is a fantastic strategy for them because it allows them to grow further, allows them to grow faster than they otherwise would be able to, and takes some of that risk as they grow faster off the table. So there's some regulatory requirements that checks those boxes and allows them to grow even faster than they would otherwise. And also those regulatory requirements are backed by sort of risk analysis, and it's lowering that risk, which is why they're checking those boxes. So it's a good strategy, and also as they mature, if they're successful as a company, and they have become profitable, they're growing, they're sustaining themselves. My guess is they will pull back the amount of reinsurance they use on a product by product basis and on a geography by geography kind of basis. So as they feel more comfortable that their auto insurance in the U.S. or in certain states is safer, then they can pull back the amount of reinsurance they're using on that product or product lines. And then as that occurs, in the future or down the way, then they would actually pull back or retain more of those earnings and sort of escalate some of those earnings within where they currently are. So that could take years, but it's interesting in a good way if you're looking at them more on a book of value, or sort of an in-force premium to market cap evaluation. Probably a better way to evaluate a company like Lemonade.
To me, it felt like a good metric to kind of measure it by relative to the legacy insurance providers. I think the auto insurance is the key. We'll see how that goes. And I think Lemonade, what's special about it with the auto insurance especially is the telemetrics they're going to be using. And what they can do with that is they can figure out who the more safe drivers are in a more realistic way, other than the old 100 years ago way of picking out who's single, what their age is, what color car they're driving. They can actually use telemetrics from their phone and say, hey, you're significantly safer with a much higher degree of confidence, and give them a better price. And those people will come to Lemonade versus Allstate or Progressive. And the bad drivers are going to say, hey, you're going to have to pay a higher premium with us. And those bad drivers will go to Allstate and Progressive. So I feel like that's sort of maybe some of the secret sauce in their auto insurance formula, not just the user experience, which I think is going to be way better, but the way they can price the actual policy holders.
So Emmet was kind of touching on some of the points I was making earlier. Yes, the user experience is significantly better, but what's even more important is how you can underwrite and risk profile individuals. So I'll give you an example of a auto, lease example from my own life the other day about auto insurance. Something that came to mind is I was driving home from work, and a guy was following close behind me. By the way, I live in Canada where the roads can be snowy and icy, and you need to allow really more time and space to allow yourself to stop carefully. But anyways, this guy, I was making a left turn. It was a yellow light, turning through the left, through the intersection, the end of the yellow. And this guy came ripping through the intersection, pulling the left turn through the red, really close on my tail. I'm not a slow, I'm pretty average, I think, sort of driver by aggression level. And so I pulled through the intersection just fine, but he was just like right on my tail, really close to my bumper, just to squeak through the red light of the intersection. These are icy roads. He's also driving like a really crappy, really bad looking old truck with the crappy tires. And then he's like following me close down this road, residential road I'm driving, and then he cut off and turned and made a left-hand turn, and he did it really suddenly and cut off right in front of a car that was coming the other way, rather than waiting 5 seconds for the car to pass through. He swerved and drove right in front of them, and went off down another street or crescent or something, and I drove on. But you have to think about that kind of person, that kind of driver, and maybe they're safe rest of the time, but I'm going to guess overall, they do that sort of behavior is not, uncommon for that kind of person. And you contrast that to someone like, say, my parents, who are baby boomer kind of aged individuals, have perfectly clean driving records, have really nice new vehicle that's safe and has good tires, well maintained, really conscientious drivers, are going to drive carefully, slowly, make sure there's lots of room in front of them. You contrast those two sort of individuals, those two driving sort of profiles, and that first guy I'm describing. I could see the case. You have to actually look at this, but sort of quantify this with data. But I could see a person like that being 10 times higher risk of causing an accident than someone like my parents, maybe even higher than 10 times. So huge factors of difference between certain people like that, who are just super unsafe, and then people say my parents that I'm describing, could be super safe, careful drivers. And if you can use telemetrics and data to capture that difference and more accurately see that difference between individuals, you can have profound effects on your insurance, because that first guy who's really dangerous, you can literally say, yeah, you know what, we're going to charge you 10 times higher rate for your insurance. So if you want to come here, you want to be insured by us, you're going to have to pay 10 times as much as this next person who's kind of a baseline or considered a safer driver. And of course, that guy, he's probably going to say, well, no way, screw off. And he's going to go to another insurance provider who can't identify the difference in risk. And he's going to go select that insurance provider. And guess what? They get stuck with this guy who could cause massive payouts for them. He could run into somebody, kill somebody, have huge payouts, huge liabilities and costs for the insurance provider, just because the insurance provider can't identify those risks accurately and price those risks accurately. So it's totally profound, as it draws more safer, conscientious drivers towards you if you're Lemonade, if you can accurately price the risk, but also discourages and pushes away reckless drivers or reckless people. And it's also profound because it translates to other bundled products. So say someone is a safer driver, it also, I don't know the data on this exactly, but I would guess you could probably quantify this with data and say, because you are a safer driver, you're also more likely to be a conscientious and safer homeowner who's more thoughtful about your home, takes care of your home, doesn't leave, light candles and leave them, doesn't leave junk, cleans out gutters, things like that, cleans dust away from furnaces, etc., etc. So you're a more conscientious, careful person. If you are a careful person who's driving a car carefully, you're probably going to be a more careful homeowner and less chance of burning down your home or flooding your home or something like that. Versus the first guy, if I'm going to guess, again, that translates in that sort of bundled sense that if you're a more reckless driver who they think, yeah, this guy is much more likely to cause an accident, 10 times higher to cause an accident, that type of person is also more typically going to have a higher risk of burning down a house or flooding a house. So they can also then more accurately price a bundling of products and really discourage that kind of person. You, as an insurance provider, you really don't want that kind of customer. You really don't want them to come to you, buy from you. So you have to discourage them and accurately price them so they go away and go to somebody else. But those safe, conscientious people who just pay their bills to you, pay their insurance premiums, and very likely nothing's going to happen. If something does go genuinely wrong, you pay them out, but otherwise it's very unlikely something will. Those are the people you want and you attract in. So you get that filtering effect, which is profound for the customer and for the insurance provider of Lemonade. So jury is still out as well on Lemonade, and really whether this risk profiling really will play out correctly or not. It's something we'll see in going forward in the quarters, coming quarters and years, especially with the Lemonade car and the Metro Mile. Will be really interesting to see, as that's a huge product for them, and huge kind of, I think you could really, the accuracy and difference in accuracy with the data they can collect could be really big. So that concludes my thoughts on this interview, or this little interview between these two guys. And make sure to subscribe for more Lemonade content. Follow me on Twitter @PaperBagInvest. And remember, it's in the bag.